Hello everyone, welcome to Chapter 15, the cost of capital. This is where we get into the discount rate, because the cost of capital is usually, the discount rate is usually based on the cost of capital or the cost of capital plus some percentage for risk. So the cost of capital is a really important concept because it underlies the discount rate when we're doing capital budgeting or valuation. And so we need to understand that number well. Now we're going to talk about all of these different elements, what it is, how it works, and we're going to use weighted average cost of capital, or WACC, as our calculation for cost of capital. This is a typical fundamental finance concept and calculation. Now, in the real world, companies tend to make adjustments to weighted average cost of capital. And again, this would be something interesting to talk to one of the finance folks about in our finance class to find out exactly what's done as at TELUS. You'll remember that there's a case where TELUS looks at cost of capital and actually uses the 10-year long bond instead of the 90-day T-bill for its risk-free rate, just as an example of how companies take the theoretical foundation and shape it to make sure that it's adapted to their companies. We'll talk about the marginal cost of capital and just briefly about separately funded projects. So the purpose of the cost of capital is, well, okay, you're selling shares and you are obtaining debt. So you're issuing financial instruments, bonds, debentures, and shares in exchange for cash. And you have to pay all that back. There's an expectation from the investor that you're going to generate enough profitability, enough excess cash that they're going to get paid back. And with the bondholders, credit holders, it's the face value at the maturity that's going to be repaid on top of the interest payments evidenced by the coupons. With the shares, it's the capital gain in the future and possibly dividends. In your case, definitely dividends for TELUS. So it's used as a hurdle rate or benchmark in capital budgeting. We can compare the IRR to it as well, or we can discount our cash flows using the cost of capital. And this is the sort of dividing line between whether we do something or not. If it generates capital over and above the cost of capital, great, we go ahead and do it. But if the return is lower than the cost of capital, then why would we do it? Because it's costing so much to, so to speak, borrow all of those funds and repay them. So if we can't generate something more than what those funds cost us, why would we do it? We can't even use it to repay our credit holders and our shareholders. So the purpose of the cost of capital, is, and this shows you kind of illustratively that idea of we've got projects that have high IRRs. Our cost of capital is the red line. So all of those projects that have high IRRs in the green, that are above the red line, the cost of capital, those we would fund. But the ones that fall below the red line, we wouldn't bother funding those projects. And of course, capital rationing plays a role as well. We've got a pink line there saying fund these projects. Now, we might not be able to fund all of those projects, but if we could, we would. Capital components. So cost of debt, right? What is the interest rate after tax on our borrowed funds? Common equity, sale of common shares, and remember, retained earnings is also part of the firm's capital. It is essentially residual earnings that are owed or should eventually be paid to the common shareholders because it's banked cash, it's excess earnings that haven't yet been distributed by dividends. So that's when we're looking at capital structure, we think of retained earnings as undistributed dividends. So retained earnings is part of the common equity or common shareholders capital within the company. And then there's preferred shares as well. And you know that those are a cross between debt and common equity. The capital structure is a mix of all three. You'll remember, well, we did pie charts in class to talk about target capital structures and how there's an expectation in an industry that there's an optimal capital structure. What percentage of the total capital is debt, what percentage of the total capital is common shares, and what percentage is preferred shares. And companies in that industry typically stay within a fairly tight range around the target capital structure or the optimal target structure for that industry. Yep. Now, Investors provide capital by purchasing their securities, but they expect returns. Since equity is riskier than debt, the expectation of return should be higher. So it's a continuum from inexpensive to expensive. Here's a nice graph that illustrates that. We've got the risk-free rate of return on the far left. You remember this looks a lot like the securities market line, right? Except we've added a few elements here. The risk-free rate of return is on the left there, and that is the 90-day T-bill, as we've discussed. And then common shares, out on the right-hand side. And when we do a securities market line, we generally have a beta of 1 equal to the expected rate of return on the market, and then we can draw this line. What this is saying is, okay, let's, we've got those 2 points, we can draw a securities market line, but we've got a whole bunch of other things we can plot along that line to show that there's a relative expected rate of return and that there's a relative riskiness, and these things have to work in concert. We don't take on more risk without the potential for more reward, so these have to rise proportionally along the line in order for investors to be interested in a security. If the security falls off the line where it's got greater risk and lower reward, it wouldn't be of interest to anybody. It wouldn't last for very long. So that's why everything that we see here is on the line. And you can see that it's got different elements across the line, and they all get progressively more risky, but they all progressively have more reward. Now, the weighted average cost of capital says, okay, let's take the percentage of each piece of the capital structure. So we've got 50% debt and 50% equity, for example. Well, that's the weight. The cost of capital for equity would be 50%, and the cost of capital for debt would be 50%. And then we just have to figure out the cost. And for each element, debt separately, by element I mean debt or preferred shares or common equity. So for each one of those, we actually take the weight times the cost, and we get a small percentage for each of those three, and then we add them up to get the total weighted average cost of capital, hence the sum on the left-hand side of this formula. So we just sum the capital elements, the weight times the cost of each element, to get the weighted average cost of capital. Now, book values reflect the cost of capital already spent, and the market values estimate the cost of capital to be raised in the near future. So, for example, if we're figuring out the target capital structure, we have a couple choices. We can look at the book value and say, okay, well, how much has been invested in common shares directly into the company? What is the retained earnings? There's our common equity percentage. How much debt has the company taken on, bonds, loans, etc. And what about preferred shares? What amount of money came into the company as a result from selling preferred shares? And we could create our target capital structure, or sorry, our capital structure, our pie, our actual capital structure or pie graph with a percentage of each based on our book values. And the problem with that is that once the shares are out in the market, the common shares, particularly for a company like TELUS, they are going to change in value, right? And in the case of TELUS, they were sold a long time ago at a certain amount, and now they've grown in value. So the book value no longer reflects the market value. Now, sometimes we don't have the luxury of market value. If it is a non-public company, we don't know what those shares are worth, and particularly if a valuation hasn't been done on the company. So when we're talking about private companies, sometimes we have to use book value, or we can estimate the market value, one of the two. But when we have a company like TELUS, when we do have market values, we use the market values to determine the capital structure and cost. Why? Because that's up-to-date information. It's market, it's real, and that is our gold standard. So between market values and book values, if you're given a problem to solve where it's like, here are the market values, here's the book values, calculate the WACC, it's looking for you to choose market values over book values because they are the most current and they are the most objectively true because the market sets those values every single day, including the bond market, right? So step one, develop your market-based capital structure. All that means is find out the market value of each of the shares and bonds, and if there are some preferred shares, and then figure out, and then add all those together to get your total capital, right? So add those three elements together for the total value, And then you just need to figure out the percentage of each to the total. What percentage are the bonds to the total capital structure? 100% of capital. What is the value of the common shares compared to the total capital structure? And what is the value of the preferred shares to the total capital structure? Because the sum of the three elements are the total capital structure, those percentages should add to 100%. So you'll get, 50, 40, 10, some sort of allocation between the three elements, but they will always add to 100% because to figure out the denominator, we add those three elements together. Then we adjust the market returns for corporate taxes and flotation costs. Remember, and we did cover this in class, but I know it was a long time ago, the cost of capital for debt is after tax. So we always take that interest rate times 1 minus the tax rate. Why? Because we get to deduct interest for our tax return as a taxable expense, right? So we have our revenue, we have our regular costs, we get to deduct our interest expense that therefore shields some of our revenue from taxation. We get paid lower tax compared to dividends. Dividends are paid after tax, right? Dividends are paid on the income statement after the net income is calculated, after the income taxes are calculated, and dividends are not deductible for tax purposes. So we don't adjust the cost of capital for preferred shares or common shares for taxes, only debt, because only interest is deductible, not dividends. Flotation cost just means if we're issuing new shares, we need to understand that we don't get 100% of the, well, it's not just shares, bonds too. We don't get 100% of what it is that we're raising because the investment bankers might take some of it as their commission. So we need to discount that, and we'll go through that. Then we put all these values together to determine. So here's a good example. If there's 10,000 shares at $12 a share, well, the value of that is $120,000. If there's 100 bonds at $850 per bond, that's $85,000. So the total capital is $205,000. To figure out the weight, we take 120,000 for common shares divided by 205,000, and we get a weight of 58.5%. We do the same thing with debt, 85,000 divided by 205,000, and we get 41.5%. So there's our capital structure in terms of our weights. So that's step one. Now, the flotation costs, oops, dang it. Okay, flotation costs. Sorry, I went too fast through that slide. The flotation costs are just 1 minus whatever percentage is being subsumed in flotation costs, and we only consider flotation costs when we're talking about new equity. Sorry about that. We only talk about flotation costs when there's new equity. So if you're talking about the existing share capital, we don't consider flotation costs. But if you're going out and raising new shares or raising new bonds, then we have to take that amount, divide by 1 minus the flotation costs to get the actual amount of that particular offering. That's used rarely. So when it comes to problem solving in finance, we generally don't do that as often because we're usually working with the existing capital structure as opposed to going out and raising more funds. Where we do use it is when we've got an existing capital structure, we know we're going to go out and raise some more money, and so we need to adjust our target capital structure for the money that we will be raising to complete all of the capital investment that we want to do. So, 90% of the capital structure might be the existing capital structure, but we're going out and raising, some more funds that represent 10% of the capital structure. So you need to incorporate that. So understanding the flotation costs is a good to know, but it's not super critical, as in we don't use it every single time. We just use it when there are new funds that need to be raised. So the cost of debt is the investor's return less the firm's tax deduction. As I said, K of debt, so the interest rate on the debt, times 1 minus the tax rate. So that's how we figure out the cost of debt. Let's do a quick example here. We have a 12% coupon rate bond at Blackstone that's yielding 8% right now, and the marginal tax rate is 37%. So we take the 8%, the yield on the bonds, because again, that's the market rate, right? The market's been adjusting. We issued the bonds at 12%. but the market has shifted and now our bond will be trading at a premium or a discount. So the overall yield is adjusted to 8% because the current interest rate is 8% in the market. The market is basically for bonds of our relative risk is paying 8%. Okay, so back to the calculation. So 8% times 1 minus 37% is 5.04%. So now we have the cost of debt. So that's how we work through the cost of debt. To finish off the calculation for WACC, for the debt element, we would multiply by the percentage of debt in our capital structure. I think on our last example, it was what, 48.1% or something like that. So we would multiply that 5.04% times 48.1%. We'd get a small percentage, which we would add to the cost of equity to determine our overall weighted average cost of capital. Okay, cost of preferred shares. So here's a good example of the flotation costs. If we're trying to figure out the cost of preferred shares, K is pretty straightforward. That is basically our dividend rate. But if we have new preferred shares, we need to incorporate the flotation costs. So 1 minus 2% or whatever the case might be. In other words, say our cost of preferred shares for a new issue of preferred is 10%. And our cost is going to be 2%, then we're going to take 10% divided by 98% to figure out our actual cost of preferred shares. Remember, there's no adjustment for taxes because dividends are not taxable. And a reminder that retained earnings are part of our common equity, not just the share issues. So both of those things need to be considered in our capital structure. The cost of common equity is imprecise because of the uncertainty of future cash flows. We use CAPM and Gordon model to stand in for the market rate for both. And we've discussed those quite a bit. Retained earnings are not free to the company because the shareholders deserve that return. We don't generally adjust for flotation costs or taxes though on the retained earnings. Why? Because they're not new for flotation costs. We only incorporate flotation costs into new equity or new debt that's being issued. And we don't adjust for taxes on the cost of retained earnings because dividends are not a tax deduction. They are issued post-tax. CAPM. So CAPM we've covered, and I think you guys are familiar with it. It's very straightforward. Basically, CAPM is the cost of our retained earnings or the cost of equity, and we need to have that risk-free rate, that 90-day T-bill rate that we start with. And then we take KM, which is the market rate, and by market we mean the stock market. So what's the overall required rate of return in the stock market right now, minus the risk-free rate. Now, when you see KM minus KRF there, that's the expected return of the market minus the risk-free rate. There's another term that encompasses both of those that equals KM minus KRF, which is the market premium. So if you're given the percentage market premium, you are essentially taking those two numbers and combining them. So market premium, say it's 8%, would be equal to KM minus KRF. So don't deduct KRF from the market premium. You only deduct it from the market rate. In other words, market premium is equal to market rate minus the risk-free rate. And finally, the last element, beta there, that's what we discussed very often and for a while there in class. Remember the 1.0, 2.0, and lower than 0 betas, which express the relative volatility, the relative movement of a share price relative to the overall market. And so the beta for any given company would be a number that reflects how widely it moves relative to when the stock market moves. And you'll remember, for example, at a beta of 1, if the market is expected to go up 10%, those shares would be expected to go up 10% based on the historical calculation of the beta. Excuse me, you might also remember we talked about the two different calculations for beta. Slope is typically used, but there's sum of least squares as well. And so if you're looking at a beta online on Google Finance or Yahoo Finance, it would be interesting to check and be sure what you're looking at in terms of whether it was calculated with one or the other, and also what their standard is for how many data points they need before they'll issue a beta, because it tends to be quite early. Anyway. I think that's it, and no, it's not it. Okay, let's figure out why it's not going forward. Oh, there we go. The cost of retained earnings. The beta on the Strand Corporation is 1.8. So here's a nice example. So 6.5%. I'm just going to move my mouse. You guys can see that. There we go. 6.5% is the risk-free rate. 12% is the market return. 6.5% again is the risk-free rate. 1.8 is the company's beta, so we multiply it through. Now, if this question said the market premium is 12%, then you would not deduct the risk-free rate in the brackets. You would just put the 12% in there, not minus 6.5%. So just a heads up for future problems. This calculation right here gives you the cost of equity in terms of the CAPM approach. So that's one way of calculating the cost of equity is through CAPM. Now the dividend growth is a second cost of equity calculation we can do. Which one do we use? Well, it depends on how much information we have. The more information we have, the easier it is to calculate, we might not have enough information to do both. Sometimes you've got enough information to do one, sometimes you have enough information to do the other. With public companies, you can do CAPM because the risk-free rate's available, the beta is available, and the market rate is available. All of those things are easy enough to figure out. But if it's a private company, you don't have a beta. So right away, you can't calculate CAPM for a private company. So we look to the Gordon model as a way of answering the question. Now, public companies can also use Gordon model. All we need to be able to figure out Gordon model is dividends, a growth rate that's expected in terms of those dividends, and again, the expectation of the market in terms of the risk. So private companies are limited to the Gordon model, and because they require dividends, only private companies that issue dividends allow us to use the Gordon model. For a company like TELUS, we can actually use both of these models to calculate the cost of equity, and then we can compare them and see which one we think is more accurate. So we're calculating P0, which is the value of the share in this case, but we're going to reverse it and solve for K now. You'll remember when we did dividend valuation, we had the formula set up just like this, and we calculated, what is the value of our share. But what we're going to do now is change the formula around and solve for K. So here's what we do. We basically say K, or the cost of equity under the Gordon model, is D0, 1 plus G. Do you remember that D0, 1 plus G, or G being the growth rate, is D1? So in other words, D0, 1 plus the growth rate is equal to D1. So either way it works. If they are new common shares, we add the 1 minus F there in the denominator where F stands for flotation costs. If it's not new shares, we ignore that. We don't actually have that in our calculation. P0 being the value of the shares and G being the growth rate. So WACC. WACC typically rises as the firm raises more capital. If you are going out and raising more shares and raising more debt, you're expanding the piece of your pie, or you're expanding your piece of pie, you're expanding your pie of your capital structure, but it's probably getting slightly more expensive because as you take on more debt, the bank is eventually going to start charging you more interest because that next piece of debt is a little more expensive. And as you go out and raise more money on the market, and the market's getting a little bit saturated, I guess, with your shares, you might have to pay a little more in terms of the expectation of the shareholders to issue those additional shares. So cost of capital tends to rise as you expand your capital pie and take on more debt and more share and issue more shares. And so the idea of marginal cost of capital is, okay, what about that next dollar to be raised? And so we can use the MCC schedule to figure out what's happening in terms of our capital budget. And in other words, it assumes that our cost of capital is not a straight line, but actually jumps from time to time when we have to pay more interest for that next tranche of debt, or there's a greater expectation of the market if we manage to issue that next share issue, that next chunk of shares that we are going to be issuing. So let's look at a graphical graphical representation because that can be really helpful. This is saying that, at $5 million, maybe our existing capital structure, we've raised $5 million in bonds and equity, and right now our cost of capital is 9.2%. But if we go out and raise more, if we go, up to $10 million in terms of capital, we're going to have an immediate jump right from that $5 million mark to 10.4% because we're going to have to pay more for interest and we're going to have to pay more on that shareholders. The other thing that comes into play is that lower amount of 9.2% is on existing capital, right, where there's no flotation costs. If we go out and get another $5 million from the market or more for that matter, it looks like we can get even more, we're going to have to pay not just more because it's riskier now. We're taking on more debt and more shares have been issued, but also we're going to have to pay the flotation cost. So that's automatically going to jump that marginal cost of capital. So that's a good example of exactly how that works. So firms may prefer another order to finance new projects. So this is what's interesting is, companies aren't going out and simultaneously, raising shares and raising debt at exactly the same time to expand their target capital structure simultaneously. What typically happens is the company's on some sort of schedule to go out and raise common shares, followed by debt, accumulate their retained earnings, and then they go out and get more debt, and then they get more common shares. And it's a bit of a dance, but everyone kind of knows the steps. The bankers know the steps, the markets know the steps, the finance people know the steps. And there's a sequencing of these things that's quite natural and normal. That would happen within TELUS. So TELUS would always be making these decisions in terms of, do we want to issue a bond? Do we want to issue a debenture? Do we want to take on more loan from a bank? Do we want to issue more common shares? And if so, exactly, do we want to do that in a private placement, or do we want to just do that by an additional public offering? So there's all of these choices that finance people are making in terms of the sequencing. Here you can see that, the first choice for companies is retained earnings because it's your least expensive. It's there, but your shareholders might feel differently about that. They may want to receive those retained earnings in dividends. But companies ultimately need to accumulate some retained earnings to give the credit holders and the shareholders some comfort that the company is generating the profits that will pay them back. So it's a bit of a dance there, right? You can't issue all of your retained earnings and dividends. You have to have some because it shows that you can accumulate profits, essentially. Debtor preferred shares are cheaper than common shares. So common shares would typically be the last choice, but that, of course, will vary with the real world and what's going on out there and the sequencing of the financing that you are raising. So an investment opportunity schedule brings all of this together in terms of your capital budgeting. And let's look at the graph because that'll make it more clear as far as what we're looking at. So you might remember that we had our projects listed A, B, C, D, E, and they are in descending order from our highest IRR. A has our highest IRR, B has our next highest, C, and so on. And the width of each of those columns indicates the investment that's required to invest in that particular project. And you'll remember from our previous chapter that for C, project C, we can start it, but we can't finish it in that year because we run out of our $5 million in the middle of the project. So we can start it and then we can do the rest of it next year. So that was where we were last year now, or last chapter. On this chapter, we're saying, okay, well, what if we went out and raised another tranche of money, maybe up to $11 million? What would we do then? Well, you can see the red line, which is our marginal cost of capital, our weighted average cost of capital goes up to 10.4%. And look, we can finish Project C. Project C makes sense. So maybe we want to raise enough to finish Project C. But the problem is that Projects D and E aren't really profitable enough or aren't generating enough cash to generate a true IRR greater than our cost of capital. So, when we raise money, we don't want to just go out and raise a little bit. we generally want to go out and raise a lot. Why? Because it takes a lot of effort, and it's just as much effort to raise a lot as it is to raise a little. In this case, the company probably wouldn't go out and raise that additional. It looks like it goes to about 11 million. So let's say it's another 6 million that they would raise, because they don't have a lot of projects that make sense. They have just one project, Project C, where it actually makes sense to finish that off in the given year. So I think there's one more slide left. Projects A, B, and C. Oh, right. One of the things that companies can do in error is to say, hey, we got this great loan for this particular project, so the cost of capital on that project should just be that interest rate, minus the tax rate, 1 minus the tax rate. But really, the overall WACC should always be used, because there's a long-term nature to the capital budgeting and a long-term nature to the WACC. The WACC overall is almost institutionalized by industry in some ways. If there's a target capital structure and there's an understanding of what the rate of returns are on debt, well, the cost of debt, the cost of equity, the cost of preferred shares, then the WACC is kind of baked in on an industry basis. Some of the players in an industry will have access to cheaper capital because of dividends, great banking relationship, stronger credit worthiness, all of those different things. But ultimately, all the players in an industry will have roughly the same target capital structure and roughly the same cost, give or take. There's definitely some give or take there because there's opportunities. So the single source of capital isn't really indicative of anything other than that one little slice for a short period of time. The company may end up refinancing the costs of that particular project during the project at a higher rate. So it's not really a good thing. It's considered a mistake to use a low interest rate to figure out whether or not you should do a project. You should always use the overall WACC of the company. And that's the end.